All right, good afternoon. We're here at the 11th Annual Capital Link New York Maritime Forum. My name is Richard Brand. I'm the co-head of the corporate department at Cadwalader, Wickersham, and Taft, which is a global law firm that serves many clients in the global shipping industry. Today we're joined by Ted Jadick, who's a shipping industry veteran. He has spent the most of his career at DNB Bank, and the last 9 years he's headed DNB Markets, which is DNB's US-based investment bank. Good afternoon, Ted. Welcome.
Pleasure to be here. Nice meeting you.
All right. Let's get into the interview. Equity raising activity has been low in the shipping industry. Do you think that equity capital markets are going to be open again to the shipping industry anytime soon?
Anytime soon. That's the key part of that question. I definitely think equity markets will be available and open to shipping companies. Personally, I do think it'll be sooner rather than later, and there's a couple reasons for that. The main one being that I really believe the fundamentals in most shipping sectors continue to improve. I said earlier today that you had a very benign supply side. That's typically been shipping's Achilles heel, and I think that really positions the different sectors in a pretty positive way. You've got some real distortion in the marketplace right now, which I think is unfortunate in a way because I think it takes investors' eyes off the fundamentals. But I do think the fundamental story is, continuing to strengthen, and I'm pretty confident that will get investors interested, paying attention again, and being ready to commit some new capital.
And what do you think? What are the elements that you think investors are looking for with respect to shipping companies? What makes them Wall Street material?
Right. Well, I really think there's several, I think, quite important criteria. Obviously, quality management, transparency and competitive cost structure, transparency around the cost structure, the market cap, the liquidity in the share is a huge driver. We increasingly see the big traditional long-only funds who have invested in shipping over the years and are still invested today, but they really are not interested in owning a share that they can't buy and sell on a liquid platform. So I think that's really a key element. I personally think companies that have a strong shareholder have some kind of a competitive advantage. I don't think it's an absolute requirement, but I do think it can be an added benefit.
What do you mean by a strong shareholder? Do you mean a large shareholder or a shareholder with a reputation?
Right. So what I mean when I say what I mean when I say that is really the shipping person in the management executive office, the guy who owned the business and took it public, but somebody who really has a meaningful stake and who has demonstrated over time the kind of necessary elements of being a successful ship owner.
Unlike the equity capital markets, which have been slow in the shipping space, debt issuances have, we're seeing more of them. There's more activity on the debt side. Why do you think that is?
I think it's very much driven by the fact that we are in a low interest rate environment, and you have fixed income investors who are looking for yield, and shipping companies can offer an attractive risk profile within a certain pricing level. That's really point one. The second is that as the banks have receded, generally speaking, from being the primary providers of debt capital to the industry, other sources have had to fill that void. I think over the last 5 to 7 years in particular, you've seen the development of the Norwegian bond market, which is an interesting alternative to the kind of traditional U.S. high yield bond market, and it's become a much more, I would say, open an active market for, for companies within the shipping and the energy and offshore spaces.
Mm-hmm. So in the mid 2000s, in the mid aughts, the New York market in particular was really booming with shipping issuances, both debt and equity.
Yes.
Since then, you're seeing shipping transactions, capital raising transactions in a number of other key markets: Oslo, Hong Kong, Singapore. Given that this is the New York Maritime Forum, how do you think New York compares currently to some of those other markets, and what does New York have to do to remain competitive in an increasingly global landscape?
Well, I think New York, the U.S. capital market is the deepest, and I think issuers, when they consider where they might want to list their shares or raise debt, I think they have to pay attention to the liquidity and the depth that's available in this marketplace. I don't think it's a question of investors in the U.S. What do they have to do differently to maintain their competitiveness? I think if they believe a company is offering an interesting equity investment profile or an interesting credit profile, I think they will support it. When I look at some of the other geographies or locations that you mentioned, I think Oslo it's obviously one we're familiar with as a Norwegian bank. Strong shipping culture, strong shipping infrastructure, and I think that's attractive to a lot of people. And around that infrastructure has, over time, obviously, developed a more sophisticated investor base, with a focus and knowledge of those sectors. Probably a higher knowledge of the sectors than the typical U.S. investor here would have. You also have a very, active active kind of high net worth individual and retail component in that market, which can be brought to bear in both debt and equity issues. Hong Kong, I'm not that knowledgeable about the Hong Kong market. I've spent some time in Asia. I tend to think it's a market that is more supportive of companies with a real Asia-centric setup. Pacific Basin is a great example. They trade very well on the equity side. It's not a market I would recommend to a European or North American company without an obvious connection to the business community or geography there to go and consider raising capital.
Okay, let's talk
at least on the public side.
Thank you. Let's talk a little bit about participants in the shipping finance market. A lot has changed in this industry as a result of the shipping crisis of the last decade.
Yes.
And we've seen major shipping banks that have served the shipping industry for decades pull out of the industry completely. What has filled that void? What has filled that vacuum? Which participants have filled that vacuum? And do you think that the changes that we've seen in recent years are permanent, or will things kind of go back to normal?
That's a big one, and it's an important one. I don't think bank capacity will ever return to the level that it was kind of at the peak. Thinking about a time when you had banks with 40, 50, 60 billion dollar portfolios. I think DNB topped out in the low 30s. A number of those banks are gone, and I don't think anytime soon will they be coming back. One of my colleagues this morning on the panel said his thought was that banks will be more of an intermediary, and I tend to agree with him. What's filled the place of the banks? As I said earlier, the bond markets have done some lifting. More recently, you've seen the emergence of private equity-backed or hedge fund-backed direct lending, funds in a way that have become active and have played a role. Obviously, the Chinese leasing product has become more pronounced and active over the last couple of years. My view generally of shipping is that it has to continue to evolve so that it's taking or it's obtaining more of its capital, from institutional investors as opposed to the banks. The new regulations are going to come in on capital on the banks starting in January. Going to make it much more onerous. So there's going to have to be that much more capital, set aside for riskier type of lending, and I think shipping falls in that category, and based on the track record, probably rightfully so. So I don't think, and the investments that shipping will have to be making in the future, as I think was discussed in good depth in a couple of the panels earlier today, are going to be the type of investments that I do think are going to require institutional support to, in a meaningful way.
So much information crosses your desk. You must have your fingers on the pulse of the industry. Tell me about sectors. What sectors do you think are poised to improve next? And which ones would you avoid if you're willing to say?
I would avoid containers. I've never probably because I've never fully understood the business model in the container shipping segment, but I find that as a sector has kind of consistently underperformed, and the juxtaposition of the liner operators and the tonnage providers, I think it's a tough one to play successfully as an investor. The other sectors right now, as I said earlier, I think the fundamentals are improving. Dry bulk's been improving for some time. Now we start to see the fundamentals on the tanker market already, coming from earlier this year. And again, the relatively benign order books, I think the regulatory environment that will accelerate some scrapping in all sectors will help. And again, I think as we heard this morning, new buildings are not in favor. Investors don't like them, company managements don't really like them. There's a lot of uncertainty connected with new buildings today. All of this tells me that I think fundamentally we're in a position where product tank, dry bulk, LNG, and the gas side. I think what gas has going that the others don't is the clean fuel angle, the ability to help start to hit those emissions targets over time, both for the industry, but for the broader economy. So I like gas, but frankly I kind of like them all. Except for containers. Okay.
One of the emerging themes in corporate governance and at the board level, at the investor level, has been ESG issues, right? Environmental, social, governance concerns. To what extent does the typical shipping investor care about ESG issues?
I think what we see is, and I said it myself this morning, I think it's an increasing part of the conversation, also from the investor side. There have now been within shipping for at least several years different indexes that have been created by different entities around these types of issues and the relative performance of companies in the space. And for sure, when you're talking, so we know it's definitely an issue the shipping companies are paying increasing attention to. Are they doing it of their own volition? I think in part yes. Are other kind of forces, pushing them and kind of all companies further down that road? I think that's correct. I think the banks are a part of it. I think the investment community will be a part of it. We take shipping companies, on the road, meeting investors all the time. That's part of our activity in showing that we have a capable equity capital market franchise, that we have an investor base here in the U.S. that we can bring to bear in transactions. And so we're part of these dialogues, virtually every day, and it is certainly a part of the discussion, of the dialogue being raised by investors with increasing regularity. So it's I think I said it's a one-way street. This is not a, this is not a, this is not a short-term trend. This is the way the world is moving. Shipping for a long time was able to somehow remain outside some of the major trends that were hitting corporates generally. And I think someone earlier today, said they have tended to be very resistant to change. This is all changing now. It's becoming a much more, it's a topic that everybody has to grapple with.
Well, Ted, I'd like to talk a little bit about your career. You've been in the serving the shipping industry for 30 years, and you must have seen a lot. And I'd like to ask you, why did you initially? What initially attracted you to the shipping industry, and what do you like about it, and why have you stayed in it and as a part of it?
Okay. Well, 30 years ago, you're basically right on that number. I was a young guy then, and I was with an institution, being a predecessor to DNB, because my bank's been through several iterations over that period of time. But I saw that it was a sector that the bank was committed to, that the bank had a strong culture around that industry. Back in the main office in Oslo, right up through the top management. So I understood it was a business that the bank was quite committed to, and I had an opportunity at a point in time then to join that team in New York. So I did it then. What's kept me interested is the bank has a leading position. The bank has access, and over time has built access to, I would say, the management teams and owners of basically every meaningful shipping company there is, and so that creates a buzz. You're often in a position where we wanted to be a lead bank. We wanted to be the primary bank on lending transactions. So we were just very well positioned to interact with all of those colorful personalities who have populated this industry and continue to populate this industry. It's an industry that I think is extremely underappreciated by most people. They don't understand what's involved with running a ship, running a shipping company. It's hard work, it's dangerous work. The men and women who work on these vessels, it's a tough job. So I thought that was very cool. I think we also saw, kind of as a bank, that it was an industry that would have to begin transitioning the way it handled its financing, and again move away from being so dominated by private companies and bank debt as kind of private, as the primary sources of debt capital. So I think we saw that the industry would have to transition into more of a public industry, and that there could be a lot of interesting things we could do if we developed our tools internally, to kind of stay up with that, and that's what we've tried to do. We've tried to, and I think we have successfully, over the last, we're in 2019, over the last 15 years, and really probably more over the last 8 to 10 years, I think we've built quite a successful and investment banking value chain that really can take care of a client's requirements, and that's exciting. I think we've positioned ourselves with a platform that can compete with anybody, and probably outcompete most, if not all. And that's something that I think I take pride in, and a lot of the other folks involved take pride in. And there's still so many more exciting opportunities and challenges ahead for the industry, again, as we heard about today, with all that's coming on the environmental side, on the regulatory side. Again, being in a pole position, being in a position where you have a real dialogue and kind of trusted advisor relationship with a CEO or a main owner or shareholders, it's just fun. It's fun and it's challenging. So.
I hear. Well, thank you very much. I really appreciate it.
Enjoyed it. Thank you.
Thanks, Ted.
Thanks for the questions. Thank you.
Okay.